Welcome back. In the last section, you learned how the close is structured across 6 phases, and now we step into the heart of it. This is where the real accounting judgment lies, where you decide what belongs in this period and what the numbers should actually say. Over the next few minutes, we will work through journal entry controls, the accruals that capture unpaid obligations, the estimates that depend on your judgment, and the contingency framework that governs lawsuits and similar risks. Grab your coffee, because this is the material auditors scrutinize most. Let me tell you where we are headed. By the end of this section, you will be able to apply the journal entry controls that Sarbanes-Oxley demands, including how to handle the riskiest entries. You will calculate accrued liabilities and reconcile them through a roll forward. You will make the revenue side adjustments for amounts earned but not yet billed and cash received but not yet earned. You will build accounting estimates that hold up to challenge, things like the allowance for doubtful accounts and warranty reserves. And finally, you will master the framework that tells you whether to accrue a loss, disclose it, or do nothing at all. Why start with journal entries? Because they are the primary mechanism for adjusting the accounts at period end, and they are among the highest risk areas in all of Sarbanes-Oxley. There are 5 types, and the risk rises as you go. Standard recurring entries, like a monthly depreciation run, post automatically and carry the lowest risk. Manual entries require human judgment and sit at the high end of risk. Topside entries are posted at the consolidated level after subsidiaries close, and they are the riskiest of all because the potential for management override is highest there. Reversing entries flip automatically next period, and automated entries flow from the system itself. So why obsess over manual and topside entries? Because this is exactly where someone could override the numbers. Every manual journal entry above a materiality threshold requires a description of its purpose, the supporting calculation, the accounts and amount, and independent review by a second person such as a supervisor or controller. Documentation must be retained for everyone. Topside entries, posted at the consolidated level, should be rare, fully documented, and reviewed by the Chief Financial Officer, because external auditors specifically target them. Entries posted to cash accounts get extra scrutiny. The controller also reviews a listing of all manual entries each period, hunting for anything unusual. Here is something worth committing to memory. The external auditor tests journal entries for specific fingerprints of fraud, and so should you before they arrive. They look for entries posted to unusual accounts, entries made late in the period or after the close is done, and entries made by people who do not normally post journal entries at all. They flag round number entries with no supporting documentation, and entries that conveniently offset or hide a prior period error. The controller is expected to review this unusual entry report every period. Think of it as a smoke detector. The patterns themselves are the warning, even before you know what is burning. Now think about a cost you have clearly incurred but have not yet paid. Accrued liabilities are how you capture it in the correct period. The principle is simple but powerful. Expenses are recognized when the obligation is incurred, not when cash leaves. The major categories include payroll for wages earned but not yet paid, the benefits riding on that payroll, professional fees for legal and audit work already rendered, utilities on billing cycles that do not match your calendar, rent, bonuses and commissions, and interest on debt. Each accrual above a threshold needs a calculation backup, a comparison to the prior period, an explanation for any swing, and sign-off from the finance director. Let me single out one accrual that trips companies up constantly. Goods received not invoiced, which we shorten to GRNI, covers items you have physically received but where the vendor invoice has not yet arrived. You accrue it at the purchase order price from the goods receipt note. Why does this matter so much? Because GRNI is the single most common source of accounts payable understatement at period end. If you miss it, your liabilities are too low and your profit looks too high. To prove completeness, the total accrued liabilities balance is reconciled through a roll forward. Opening balance plus new accruals minus payments and reversals equals the closing balance, tied back to the general ledger. Here is where auditors lean in hardest, because the revenue side is the highest risk for earnings management. There are three adjustments. First, unbilled accounts receivable. When you have satisfied the performance obligation under Accounting Standards Codification 606, but the billing milestone has not been reached, you recognize revenue and create an unbilled receivable. Any unbilled amount older than 60 days should be investigated. Second, deferred revenue. Cash received for obligations not yet fulfilled, reviewed each period and rolled forward. Third, for complex multi-element contracts, the transaction price is allocated across each performance obligation, and the contract asset or liability is updated as estimates change. Why treat these revenue items so carefully? Because both unbilled receivables and deferred revenue rest on management estimates about the timing and amount of when performance obligations are satisfied. And anything that depends on judgment is, by definition, something management could lean on to bend the result. That is what we mean by management override risk. The defense is the same every time. Strong supporting documentation, a clear and consistent methodology, an independent review of any change to a revenue estimate. When you can show your work and show that someone else checked it, the estimate stops being a soft spot and becomes a controlled, defensible number. Many balance sheet accounts require management to estimate what will ultimately be realized or paid, and this is the most subjective part of the entire close. Take the allowance for doubtful accounts, which under current expected credit losses, or SECL, reflects expected losses over the life of the receivable. The inventory obsolescence reserve comes from aging analysis. The warranty reserve is built each period from sales and historical claim rates, then reduced as actual claims come in. Restructuring charges are recognized when the liability is incurred, specifically when a termination plan is communicated to affected employees, not when management privately decides. Environmental liabilities are recognized when probable and reasonably estimable. Now for the framework that governs lawsuits, environmental claims, and similar risks. Accounting Standards Codification 450 turns on two questions. How likely is the loss and can you estimate it? If a loss is both probable and estimable, you accrue it, debiting the loss and crediting a liability at your best estimate. If it is probable but you cannot estimate it, you disclose only. If it is merely reasonably possible, you also disclose only. If it is remote, you generally do nothing at all. And here is the rule people forget. A gain contingency is never accrued. Under conservatism, you recognize a gain only when it is realized. Legal contingencies are uniquely sensitive, so let me show you how the process works. At year-end, you send a formal letter to all outside counsel requesting a description of each pending matter, an assessment of the likelihood of an unfavorable outcome, and an estimate of the potential loss if it can be determined. Here is the friction. Lawyers are often reluctant to give specific estimates because those numbers could become discoverable and used against the company. The accounting team must then use all available information, including management's own assessment, to set the accrual and disclosure. The legal note must be approved by counsel before issuance, because any inconsistency between the accounting and counsel's view is a significant audit risk. What happens when a policy changes or you find a mistake? Accounting Standards Codification 250 gives three paths. A change in accounting principle, such as moving from first in first out to weighted average, is applied retrospectively, restating prior periods as if the new method had always been used. A change in accounting estimate, like a revised useful life or bad debt rate, is applied prospectively with no restatement. A correction of an error is handled by restating all prior periods presented. For an SEC registrant, if the error is material to a prior period, those statements must be restated and refiled under the non-reliance rules. Knowing which path applies is half the battle. How do you decide whether an error even matters? The Securities and Exchange Commission, through Staff Accounting Bulletins 99 and 108, applies both quantitative and qualitative tests. Quantitatively, an item over 5% of a benchmark like net income, revenue, or total assets is presumptively material, while an item under 0.5% is generally immaterial, and the zone between requires judgment. But the numbers are not the end. Qualitative factors matter too. If the item involves fraud, masks a trend, hides a missed analyst target, or flips a profit into a loss. And Staff Accounting Bulletin 108 requires you to test under both the rollover and iron curtain methods. The error is material if it is material under either one. Let us pull the threads together. Journal entries are the engine of the close, and manual and topside entries demand the tightest controls because that is where override hides. Accruals put expenses in the right period, and goods received not invoiced is the most common source of payable understatement, so chase it down. The revenue side and your reserves rest on estimates, which means methodology, documentation, and independent review are your protection against management bias. And when a loss looms, the ASC 450 framework tells you whether to accrue, disclose, or do nothing, while gain contingencies are never accrued. Carry these instincts into the next section. Thank you for completing this section on accruals, estimates, and contingencies.